Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We provide actionable investment ideas and timely market commentary to hedge fund managers, portfolio managers, family offices, RIAs, and high net worth individuals. We help people get better returns in the equity portion of their portfolios. And lately, for obvious reasons, we've been focusing on inflation, higher interest rates, and how to hedge. Very excited to be joined today by James Davolos of Horizon Kinetics. Horizon Kinetics is a $5 billion asset manager. They were early on Bitcoin. They own hundreds of millions of dollars of Bitcoin. And James, in particular, is really important for today's conversation. He runs the Horizon Kinetics Inflation Beneficiaries Fund. It's a new ETF that seeks to take advantage of the inflation that we're seeing. And rather than go down with a ship like so many other portfolio managers have, James is positioning his fund to outperform or actually make money from the current trends. James, thanks so much for being with us.
Thanks so much for having me.
All right. So just as a background, we're going to give you guys a little bit of a background on what's happening, what's causing inflation, why we think it's misstated, and then James is going to jump into the conversation. He and I have discussed and debated this stuff on previous calls before. So there are two key things that are behind the huge increase that we're seeing in inflation recently. One is quantitative easing, or what's frequently referred to as money printing. 80% of all US dollars in existence have been printed since the beginning of 2020. All of those 3 trillion, 4 trillion, $5 trillion pandemic related things that we've seen, the Fed flooding the system with cash, guess what? That causes inflation. The other thing is we've had interest rates at or around zero for somewhere in the neighborhood of, James, what, 12 years, 13 years, something like that. Yeah, that bill is starting to come due. And so what we've seen over the last few months is a huge increase in inflation. Last month, we were at right around 7%. Today, we got a number 7.5%. That was above expectations. James and I have been looking at this from similar but different points of view. We are saying that the inflation number that you're all looking at is complete and total nonsense. One might even use the word lies, and here's why. When they say 7.5%, there are calculations that are being done, and they basically take a basket of goods. Okay, but let's take a look at some of the components. And we have this morning's print from the US Bureau of Labor Statistics. These are the official US numbers. The shelter number, which is the fancy word for housing, was up 4.4%. Is there anyone on this call who thinks the cost of rent, the cost of buying a home has gone up 4%, 4.5% in the last year? The number is clearly nonsense. If you look at the Case-Shiller index, that's showing numbers in the 18, 19% range. If you look at Zillow, and granted, Zillow isn't the most accurate site in the world, but they're showing 17, 18%. If we adjust just based on the shelter number alone, which is 1/3 of the CPI, that 7.5% number goes to 12.5. One other number that we're looking at is food. James, what was the food number? 7% last month?
For the year, it was for month over month was 1, so that annualizes to 13. But the 12-month rolling was 7.4.
Okay, got it. All right. So, right, here it is. Food at home, 7.4. Food away from home, 6.4, averaging out to 7. That's the year-over-year number. And I'm just going to ask everybody on this call, like, raise your hand. Like, do you really think your food bill is only up 7%? When was the last time anyone ate in a restaurant? Prices are up a lot more than 7%. If you're going grocery shopping, the price of beef, eggs, chicken, milk, bread, everything is up more than 7%. Food makes up more than 13% of the index. And so what we're saying is that the official government statistics are 7.5% inflation. We think that's nonsense. It's double that. The real number is closer to 15%. And on top of all of that, interest rates are still zero, and the Fed is still flooding the economy with more cash. And so what we're seeing is a situation where Fed Chairman Powell, who in fairness is in an impossible situation, But he's basically talking tough and talking the markets down and saying, we're going to get serious, right? You're all going to have to eat your broccoli. All right. Well, is anyone really eating their broccoli? The actual Fed funds rate right now is 0. If you believe the official US statistics on inflation, the real rate, which would be the 0 Fed's fund rate less the official inflation rate, is negative 7.5%. I think that's an all-time low. And then if you look at what we think is the real rate, meaning the rate of actual inflation, real interest rates are negative 15% right now. And on top of that, quantitative easing hasn't stopped. I think this month they're talking about increasing the balance sheet of the Fed by another $30 billion. So it's another $30 billion of liquidity into the system. The way we think about it is, imagine somebody dying of a heroin overdose and the doctor says, okay, we're going to reduce the heroin, the amount of heroin we're giving them. Right? They're still putting liquidity into the system. James, at this point, I want to pull you into the conversation. What am I missing? What do you see differently? What do you want to add to just the general inflation? Do you think 7.5 is the right number, or is it nonsense?
No, I mean, obviously, I think that it's clearly massaged. And, something else from this morning's release is, if you scroll down near the bottom, there is a disclosure about what they call the intervention adjustment, where they basically adjust series to kind of smooth out the base effect. And the example they give was fuel prices in the 0809 experience, which, if people remember, we kind of had that big spike in energy going into the Great Recession, the global financial crisis. But if you read down in the paragraph, they adjusted 70 series for January of 2022. And I'm not a betting man, but if I was, I would bet that those were adjusted lower, not higher. To your point with food, the United Nations FAO index, which I think is probably the most objective and reliable index for food worldwide, is up over 24% year over year. So there's a lot of other numbers going on here, plus the thing that everybody already knows, which is that CPI is prone to manipulation via the substitution and hedonic adjustments. So now you've also got the intervention adjustments. And, one thing I will add to your comment on the owner's equivalent rent. So the biggest part of the shelter component of CPI is owner's equivalent rent. So they run around, they ask people, hey, what do you think you can rent your house for? They don't really know. They haven't tested the market. However, I've seen some people do kind of a regression of that relative to the CPI. And there is a lag of anywhere from it's a little bit over 6 months, so maybe 9 months out to as much as 18 months. So this is going to be a big bugaboo for the Fed and the BLS as that number kind of catches up. The other big number was urban wages. So urban wages were up 8.2% year over year. The monthly print annualized to about 11.5. So moderately above reported inflation. But if you see kind of what the big employers are doing, the McDonald's, the Walmarts, the Amazons, those would actually suggest higher than those reported numbers. So you've got wages, you've got housing, you've got food. You have a lot of things that I think it's going to be pretty tough to argue are supply chain related with a straight face.
Yeah, all great points here. I want to emphasize 2 points that you were making. One, let's just make sure everybody on this call understands, when James talks about 70 adjustments to the CPI, here's what happens. What happens is they do these calculations, they look at the number, and then they say, yeah, we don't like this number, we're going to adjust it, right? I mean, listen, I'd love to do that. I used to run a hedge fund. Can you imagine? We have a 1.5% month, and I say, I don't really like where these stocks are, right? Congratulations, we had a 5% month.
You mean you don't run a private equity fund where you can just say what your marks are whenever you want?
Exactly, right? But just realize the market on a daily basis is trading off of these government statistics. Literally, in my entire career in finance, I do not remember a morning like this one where people were so fixated on a government number. And here's the thing we want to convey to you: that government number doesn't represent reality. That government number is a political number. They're giving you that number. And what we're doing, what I'm doing, and I think James agrees here, is we're saying 7.5% is not the right number. Inflation is much worse. The second, and James talked about food inflation. He's right. The UN Food Index up 24%. So do any of you believe that in the United States, where we eat a lot of beef, a lot of pork, a lot of high-end food, that our food inflation is somewhere between 1/3 and 1/4 of what it is for the rest of the world? That's not believable. Now, James also was talking about owner's equivalent rent. If you guys give me 1 second, I'm going to share my screen and we're going to bring up the chart. Here we go. And now you guys, we're sharing the screen. So this chart will show you that this red line is the Case-Shiller National Home Price Index. And this is the best guess we have on actual price inflation. And what we can see, right, here's where we had the beginning of the pandemic and people said, oh no, we got to move out of the city. And right here, that's your big increase. This line down here, this is what James was talking about. This is owner's equivalent rent. They're going to people who don't rent out their homes and saying, hey, you know, what would your home rent for? And most people say, I don't know, you know, and they pick a number that's sort of similar to what they had before. And that's why, look, you see these big increases before the housing bubble as people bought homes and renovated them and leveraged them up. And then this decrease during the housing crisis, this huge increase due to the pandemic. And through all of it, real home prices have been volatile and gone up a huge amount, while we've seen the owner's equivalent rent be very stable. People don't really react to pricing in this way. So James, I think this is what you were talking about, all shown in a chart for why these numbers again are nonsense.
Yep. And, you know, I think you brought up another good point with the UN FAO index, because let's just take something, there's not many things that I think you can say with certainty, but I think one thing you can probably say with near certainty is that most global governments are going to pursue some form of real per capita GDP growth. It's what keeps you in office. It's healthy for the economy. It's good for society. It's good, especially for the lower working class. And this is critical for the non-OECD countries, so the more developing nations. So historically, there's two things that correlate but correlate very highly with real GDP per capita growth. One is energy consumption per capita, and two is caloric and protein consumption per capita. So now you can argue what the mix of energy is going to be. You can argue what the mix of the food and calories and proteins is going to be. But there's billions of people in Southeast Asia, in India, in China, in Eastern Europe, even in sub-Saharan Africa, coming off an extremely low base. They're pulling more of this demand for these agricultural and protein products and also energy. And then here's where it gets reflexive. Energy is one of the biggest inputs into fertilizer. So you have rising fertilizer prices, which go into the grains. The grains actually, there's actually a bigger driver for grains into feeding the cattle, the chicken, the higher density calories and proteins. And then it's basically this self-fulfilling cycle of inflation between real per capita GDP growth, energy, ag, rinse, wash, and repeat. And this thing can spiral out of control pretty quickly.
Okay, so then I want to address two ends of this. The thing I want to talk about is why I think the GDP number we're seeing is overstated. But the thing that I'd love to have you address first is, okay, so what happens? What happens when food prices go up, when there's inflation in places where people can't afford it, right? Because we're about to see that through much of the globe. And as you pointed out, if energy is more expensive, fertilizer is more expensive, that's going to make food more expensive. What happens in places where you have high population density without a great deal of affluence?
Yeah, I mean, putting our finance hats aside for a moment and just looking at it from a humanitarian standpoint, it's very concerning. The food crises, food shortages, inavailability of food, pricing of food has been the spark that hits the powder keg in a lot of civil unrest, coups, wars, really unpleasant things. And so governments are going to have to do something to get a handle on this. But I think when a lot of people say that the Fed is really boxed in, they really are, because on the one hand, you want to promote economic growth. But with economic growth under the pre-existing conditions, you're going to have inflation. So you fight inflation, you risk recession, you risk jobs, and there's just no way out of this other than, there's just no wherewithal for anybody to take the Volcker era medicine that, basically are, well, at least my parents endured for a big part of their adult life. There's just, society isn't willing to do it. People aren't willing to go through that common good. So, I think that the trend is going to be to much higher than pre-crisis inflation levels, by virtue of just the world is going to run pro economic growth policies above all else.
I agree with you. And I think Powell is in a no-win situation right now. He got handed a situation that's just been decades in the making, and whatever he does right now is going to be a huge problem. And I do want to talk about GDP, but you brought up something that I think is really important. A lot of people look at what you and I do as kind of being this bloodless finance, almost mercenary kind of job. And the reality is these numbers, these economic numbers that we're talking about, really impact people. When you look at an inflation number of 7.5% and you have elderly people on fixed income, right? What happens? Do they have to move? Can they afford to move? Can they afford food? These are really important things. And it's worth it to tell a little bit of a personal story right now. Many years ago, when I was starting a hedge fund, my partner and I at the time agreed we wouldn't have any individual trading, no individual stocks. And my dad had bought me 19 shares of Atlantic Richfield. I was maybe 6 months old, something like that. And so, I had to go find the stock certificate and sell it. And here I was as an adult, and I'm looking, I'm thinking 19 shares. It's a weird number. It's a really weird number. 20 would have been a round number for everyone on the call who's Jewish. You'll recognize 18 would correspond to the letter Chi, and it's a symbol for life. So that might have been significant. 19. It's really strange. And so I took a look. I looked at the price of Atlantic Richfield at the time, and multiplied it by 19 and realized that it came to $247 and change. And all of a sudden, I realized my dad had $250. And so for that moment, I was sitting at my dad's desk, and I pictured myself as a 27-year-old man with a wife and a kid and just starting a career, and $250, right? And in that moment, I saw the stress that was on my dad. I saw his anxiety. I saw his desire to plan for the future to help me. But that's what you can get from a financial statement. When we look at 7.5% inflation, and James is talking about there can be an impact on political stability, on people's quality of life, on their level of security. These numbers matter. There are human beings behind all of it. And I'm really glad you pointed it out, because it reminded me of a moment when just looking at a financial statement made me feel empathy for my dad and the pressure that he felt. It's really important.
I mean, that's a great story. And I mean, kind of along that parallel, the other tricky part is that think about how many defined obligations of the federal government, of state governments, whether it's Social Security or Medicare, Medicaid, or any number of these or all these pensions that are indexed to CPI or a derivation thereof.
Mm-hmm.
So on the one hand, you're saying, okay, these poor people, you need an accurate measure so they can they made a deal. They made a deal, 30, 40, 50, 60 years ago to theoretically have a very nice, comfortable existence in their retirement. But now we don't have the money. So we have to manufacture a lower number. So the longer CPI runs hot, the longer these entitlement bills get bigger and bigger. And then we're talking about raising rates on the back end. So it's like, all right, I'm going to jack up what you guys have to pay to all these entitlement programs. And then just to make it really special, I'm going to jack up interest rates for when you have to go borrow more money to pay for it. The dollar's got to get debased. That's the end.
Right. And that is going to happen. And for anybody who's not familiar with finance speak on the call, the way you debase the dollar is inflation, right? And that's what we're looking at. And this is going to be a long-term problem because James is right. We have obligations that cannot be paid unless we pay them in dollars that aren't worth very much. Also, I just want to paraphrase something that James is saying because it's really important. Just picture for a minute that you're a senior citizen and you're on Social Security, you're on your fixed income, and your payments get adjusted by the inflation amount. So your payments might get adjusted by 7.5% now. But what if inflation, as we think it is more like 15%, right? All of a sudden, your quality of life just went down, and some of these people may not have that kind of margin for error, right? For a lot of the people on this call, if your food bill goes up 15%, that'll be annoying, but we'll be fine. But that's not okay for everyone. And I think that's the point you were making, James.
Exactly. Yeah. I mean, we just are so privileged. Even people in the bottom 20% of US households, the fact that we can just go to a grocery store and most people have some means of getting that food. This is going to be a huge problem in the non-OECD world. And, I'm not sure. I'm sure there's a lot of stories on the ground that's not being properly or thoroughly reported here. But, food, again, is the really big one to watch from the humanitarian, geopolitical, social standpoint.
Got it. Okay. By the way, everyone, I just got a note from somebody that I'm hard to hear. Give me 1 second. I'm going to turn up the volume on my microphone. But we should, hang on, Ronnie, I'm turning up the microphone volume. Thanks for the note. I appreciate it. Hopefully this is better. By the way, everybody, if you can't hear me or you can't hear James, send me a note, use the chat feature, send me a note in that. And if any of you have questions, just send it through the chat. Okay, good. Thank you, Lawrence. But if any of you have questions, just send it through the chat. We'll deal with that as well. So James, I want to talk about GDP because the number we got for last quarter, 7%, that's a pretty good number, right? If you believe it, and we don't. And let's explain why. So that 7% number was the official headline number. Of that, 5% of it was inventory stocking, right? Which nets to zero. So you sell a bunch of stuff during the holidays, you have empty shelves, and you buy to refill the shelves. That's not actual economic activity. That's just inventory going in and out, right? The next thing is there is an inflation adjustment. So James was just talking about an inflation adjustment for Social Security payments. There is an inflation adjustment also included in the GDP numbers. And so for last year, it was 3.9%. Again, does anyone really believe inflation is running 3.9%? It's a ridiculous number, right? We think it's closer to 15%. The official number is 7. Okay, that's off by a factor of somewhere between 2x to 4x. So if that's the case, guess what that does? That puts the actual GDP number negative. And then we've got one more thing we're looking at as well. I assume everyone on this call has heard about port congestion. And so if we take a look, everybody was worried that we wouldn't be able to get goods to buy presents for Christmas. And in October, the White House came out and they said, we're going to address the issues at the Port of Los Angeles, right? And the Port of Los Angeles was all backed up, and the Port of Los Angeles and the Port of Long Beach handle 40% of US imports. And so what we did was we went to the website for the Port of Los Angeles and pulled the actual container data. Now, the White House said in October, we're going to improve things. We're going to make things better. Well, things got worse in November and worse again in December. And so the question is why, and why does this matter? And the answer is because imports are subtracted from GDP. So if you slow down the ports and you have fewer imports coming in, your GDP is temporarily higher. So here's the conclusion that we would draw. Actual GDP right now may have gone negative. A recession is defined as 2 quarters of negative GDP growth. We might already be in that now. And then if we combine that with inflation, guess what we get, James? This is to you. Remember it?
Stagflation.
That's the word. Okay. So that was the word that came out during the Carter malaise. For everyone on the call who has political leanings, we are not picking on the Democrats. The Republicans have done plenty of stupid things from an economic point of view and have joined the Democrats in overspending. Both parties overspend. We're not taking a partisan view. If you think we're picking on the Democrats for getting us into this, the Republicans have run up huge debts themselves. President Bush was a huge spender. President Trump was a huge spender. We are not making a partisan statement, so you don't have to get wound up over that. But during the end of the 70s, during the end of the Carter administration, there was this economic malaise that James has correctly called stagflation, and there was the invention of a measure called the misery index, which is maybe the best named economic indicator of all time. The misery index is defined as the unemployment rate plus the inflation rate. Currently, the misery index is running about 11.5%. But if you believe our inflation numbers rather than the BLS numbers, Bureau of Labor Statistics, we actually think it's running 18.5%. We maxed out at 21 during the late 70s. So, you know what? I've got some charts on some of this stuff. I'm going to find them. James, going to you, though. What are your thoughts on this? Do you think GDP is properly stated, or are we looking at something else here?
Yeah, I think you bring up a good point, and I don't think it's possible to accurately quantify the size of the US or any global economy. I think, again, it's like CPI. It's an imperfect attempt that there's some obviously huge shortcomings. But to clarify for people that, again, aren't necessarily in finance, the GDP figure that you hear on the news and the newspaper or on Twitter, whatever it may be, that is real economic growth. So the growth number less the government number for inflation. And then here's a nuance, which is really important. The GDP number uses a different metric than CPI or even PCE. They deduct a number which they call, I believe it's called the GDP Purchasing Cost Index or something like that. But again, you have three different government measures here that are all being kind of conflated with one another: CPI, consumer, PPI, producer, and then I think it's the purchaser's adjustment for GDP. So again, that number came in at less than 4 for the year to basically result in this net 7. Whereas if you were to use kind of a true number that kind of you lose 3 points of GDP growth based on CPI. If you kind of use Gary's math and say, let's just adjust the shelter number, now you're negative. So, big spread here based on exactly how you calculate your data. But again, it's going to be really tricky. And there's, I'll see if I don't know how our compliance will feel about this, but if you look at our Twitter, I think this will be out in a couple of days, if not already. If you go back to the 1980s and look at the total return for the S&P 500, so kind of that peak Volcker, I believe the 10-year hit 16. The S&P was trading somewhere around 7.5 times earnings. The dividend yield was 5.5%. Fast forward to the end of last year, your total return is about 40x in capital terms. So that's a 10x, that's 10% per annum. Then you can add about 2% a year with dividends. So that's 12% annualized. So you'd think, wow, that's pretty good. But then if you actually adjust it and look at what was earnings growth over that period of time, I believe the number was somewhere around 11x. So you got 11x in earnings compared to a 40x in the index. So obviously, what explains that? So first of all, you went from 7.5 times earnings on the index to 27, but also really importantly, inflation. So I mentioned nominal earnings, which are not discounted for inflation, were up somewhere around 11x, huge number. Real earnings were up about 3.5, maybe 3.9 times. So again, if you were capitalizing the index at the same level, so 7.5 times for a 5.5% dividend yield, your real earnings only went up 3.9 times. So that's your return over that time period, not the 12% annualized. So almost 90% of your total rate goes away because of that multiple expansion and inflation. So yeah, these are important numbers we're talking about here.
All right, so I'm going to try to pin you down. You can duck the question if you want. What's your best guess on what the real GDP was last quarter? Do you agree with me that it was negative, or do you think it was positive? Are we in a recession already without people realizing it, or you still think there's a positive number out there?
No, I mean, it's clear as day. Let's just take CPI, adjust just the housing number. That takes reported GDP below zero. And one silver lining as a caveat. So yes, I agree it was negative, but my silver lining is that velocity of money still remains very low, which could be a harbinger of much higher inflation if that number starts to pick up. But let's invert it. And why are people not spending money? Why are people hoarding cash? Because they're scared and there's uncertainty. Because they don't know if there's going to be another lockdown, another wave, another variant. So I think that when there is confidence and comfort, and I don't think that there's going to be a magic moment where someone snaps their fingers and like all goes back to normal. But at a certain point, businesses, individuals are going to have to start investing intermediate term again. And I think when that happens, the velocity kicks up big time, and then you get real economic growth, but it could actually result in an even higher inflation. So that's my silver lining to my agreeing with you that GDP was actually negative.
Got it. All right. So James, I'm going to come to you with the next question on what should people be doing about this, and how are you investing? What are you thinking about? But before we do that, I'm just going to share my screen really quickly so people can see. Hang on real quick. So this is the container levels from the Port of Los Angeles, right? So here's October, November, December. Wow. Right? This is not a situation where imports are being properly reflected. They're falling off a cliff due to port congestion. It's not getting fixed, it's getting worse. And then the other one, here's the misery index. So this is the end of the Carter years. We peaked at 21. Right now, this 11%, you got to adjust it by 0.5% on the new inflation number. That takes us to 11.5. But if you believe our inflation numbers, which I think are a lot more accurate, it puts us right around here. And wow, you got to go back 40 years to get to these levels. And so this is why we're concerned. So James, I think we've made a great point for why people should be concerned, why we are concerned. Let's talk about inflation beneficiaries. Where would you be investing capital right now?
So the first place is hard assets. So you want a hard asset. It's finite, it's tangible. There's inelastic demand, meaning something.
James, we lost your audio. Can you go back one sentence, please?
Sure. Hard assets. So you want and what is a hard asset? It's tangible, it's finite, it's high quality, it's low on the cost curve, and there's inelastic demand. What I mean by inelastic demand is something that, look, you're going to still drive your car, you're still going to heat your home, you're still going to eat. So those are things with fairly inelastic demand. You're going to sacrifice other things in order to have those things. And so I think a lot of people kind of have this view, and a lot of people basically point to commodities. I think what that approach misses is that a lot of these companies are going to be able to push their top line revenue. So yes, if prices go up, anybody involved in oil or gold or iron can certainly raise revenue, but their costs are also going to go up. So what we overlay is what we call a capital light business model, where we look for companies with a lot of scale, a lot of operating leverage, and not a lot of debt. So basically, these companies can withstand what's going to be volatility, both in CPI, hard asset prices, the economic cycle, because the end game is pretty clear. It's a debasement, it's an inflationary cycle where you're going to want to be in these tangible assets, but the path to getting there is very uncertain. So we look at very nuanced business models, and I can give you just a few examples and juxtapose them against maybe more conventional approaches. So real estate, a lot of people say, well, if there's inflation, you want to own real estate, you can raise rents. The problem is you're paying 2-3% cap rates for high quality real estate. That means 33 to 50 times operating income from that property. If you can raise your rents 3, 5, 7, 10%, whatever it is a year, The problem is your cap rate, meaning your valuation, is going to the cap rate's going to go up, your valuation is going to go down. So if that 2 or 3% cap rate goes to 6 or 7, you're in a lot of trouble. The way we play it is basically through the capital light general partner model of something like a Brookfield Asset Management. They just reported earnings today, which were incredible. Their main verticals are real estate, global listed infrastructure, renewable energy, things like that, all real assets. But instead of owning them directly, they do have some co-investment. They earn a fee, and a lot of it's on permanent capital, and there's a base fee and a management fee. So as all of these people are out there looking at a 10-year at 2, the Barclays Ag slightly over 2, they're going to say, hey, I need something that can at least somewhat go up in his CPI index. So, Brookfield's the type of business where they can print 30, 40, 50, even 60% operating margins. Another good one with food. We mentioned food earlier. Hard to really understand where all the cost frictions are going to be for a meat processor, a fertilizer company, a seed company, because again, there's a lot of cost of goods sold. There's a lot of wages. There's a lot of SG&A. There's a lot of things like that where, does the top line rise, but then do all your costs go up? So your profits are basically static. We like something like an Archer Daniels Midland, where it's a processor. They process the world's grains and seed oils into finished and intermediate products. So flours and olefins and starches and sweeteners. So they procure these from around the world. They process them, then they transport them to basically where they're in demand. And if corn and soybeans and all of these different products go up, let's say 100%, they're earning the same spread, 300 to 500 basis points on crushing or milling that. So they're the toll booth. Brookfield's the toll booth. I think it's the toll booth businesses that are going to give you that great long-term return. And I'll just conclude with saying the caveat that, look, if you have a crystal ball and you know what prices of oil or gold or copper or corn are going to be in 6 months, you can buy a levered future. You can buy an upstream producer that has a lot of debt. But we don't have that ability to basically make those short-term forecasts. So we're looking at the businesses that are the long-term secular winners, not the basically trading range winners of kind of the fits and starts of inflation.
All right, all great points. For what it's worth, we've always been with you on the toll booth businesses, right? I mean, owning businesses like KMI, where everybody thought they were tied to the price of oil, they weren't. It's the volume of oil, right? And as you talked about, a certain amount of that demand is inelastic. Railroads historically have been some pretty good businesses, right? Own that means of getting goods from X to Y without having to make a bet on the price of those goods, the value of those goods. We've always liked those bets. One thing I do want to challenge you on, and you and I have had this debate before. I know you like the capital light model. Here's why I want to challenge you. I'd love to get your response on it. My argument for capital heavy during inflationary times, and I agree with you entirely. You pointed out we are going to need to debase the dollar, right? It's the only way we're going to fulfill our obligations, if you want to call it fulfilling our obligations, right? I mean, if that's the definition, all right, that's what we're doing. But what I would want to do, if the dollar over the next 5 years, 10 years, 20 years is going to be hammered, is going to be debased, why not buy capital heavy, leverage up? You own the asset, you own the hard asset, right? The heavy capital asset. And what you've done is borrowed in dollars that you can pay back later with dollars that aren't worth very much. And for what it's worth, I just did the same thing personally. A few months ago, I refinanced my mortgage. It's a 30-year mortgage, right? I'm dying to know how many loaves of bread it'll take me to pay off the mortgage 30 years from now, right? I mean, maybe what I should just do is buy a few shares of Amazon now and hold them for 30 years and use that to pay off the mortgage, right? Is that a possibility, right? So why not, if you think we're going to debase the dollar, why not go capital heavy, leverage up, and pay it back in dollars that are worth less later?
Yeah, look, and I think you're right. It's all about risk profile and kind of what amount of your risk bucket are you allocating. So yes, that is the high beta, high risk, high reward. Because, let's say we do tip into a recession. Let's say at a certain point, inflation's enough, you get some hawks, or these companies have to roll over their debt and they've got, a laddered maturity, 3, 5, 7 years at 4, 5, 6%. And then they got to roll that over at 12, 14, 16. So again, I think the maturity of that debt and your risk profile. So if you can do it right, you can make a fortune. And, to your anecdote about your mortgage, like I wish if I was a billionaire, I would do exactly what Hugh Hendry's doing. So people that don't know him, he was a very successful hedge fund manager in Europe. He bought 2 mansions in Saint-Tropez with interest only loans that he said every private bank in Geneva was tripping over themselves to lend him, in one case 16 million euros, in the other case like 10 million euros, sub 2% interest only. So again, let's just do easy math. 2% of interest only. You pay no principal on that 10 million euro mansion. So you're talking less than he could rent that for a month in peak season in Saint-Tropez for him to own that house. So he rents it out for a month, pays the mortgage for a year. The IRR on that is literally off the charts because there's like no capital at risk because it's an IO secured by his other investments. So yeah, if that's the billionaire's way to play it, that's for sure.
All right. So the good news is we've got Chris Bell, National Sales Manager for Horizon Kinetics, on the call. Chris, here's what we need to do. We need to set up an LP to buy property in Saint-Tropez that we can rent out or put on Airbnb. And what we want to do is finance it with interest only. James and I are in. We'll both invest in it. Chris, can you put that together for us?
Yes, and I think your collateral should be Bitcoin, so that when Bitcoin goes up tenfold, you'll be paying it back with even less. So yeah, that sounds like a good deal.
All right, everybody who's on this call, you got first rights to invest in the Saint-Tropez interest only backed by Bitcoin limited partnership, managed by James and organized by Chris. So I think it's a great idea. I love it.
One other thing I want to touch on before I have to jump in a few minutes here. Sorry, I have a conflict, but
of course.
The energy situation is too big to ignore. And, I'm not sure if maybe I'm just reading all of confirmation bias, but, we needed to start developing hydrocarbons, namely oil and gas, because gas is the transition fuel. If we do it correctly and clean, extract it. You saw these crises with LNG cargoes internationally. There's actually one in Boston because there's no pipelines, but the CapEx hasn't happened, and we're going to be on hydrocarbons a lot longer than people think. And so there's a lot of ways to play it. I think the best way is the royalty business model. Specifically, one of our biggest holdings, we've been in it since 1995. Credit to Murray Stahl. I was in grade school. They own almost 1 million acres of surface land, almost over 500,000 gross royalty acres in the heart of the Permian Basin. So the swing producer in the world today is no longer OPEC. They're underproducing their quota. I don't think that they're conspiring in a room with Putin to say, let's not produce. I think that their capacity is overstated and they don't want to let the world know that. The swing producer is going to be North America. Canada's got a lot of latent production, but all North American production is concentrating on West Texas. And so, TPL is only about 10% developed. They've got the optionality of this 100,000 acre, almost 1 million acres of surface. There's water, then there's renewable potential as you have all this acreage when wind and solar plugs into ERCOT, the power grid. So, just thinking along these lines, there's very few businesses with this much nuance and to play what's probably going to be a 15 to 20 year cycle of energy. And, hopefully we figure something out because right now the solution isn't there.
All right. So everybody on this call, the company that James is talking about is Texas Pacific Land Trust. TPL is the ticker. Horizon Kinetics has done an unbelievable amount of work on this. James, I know you are limited on time. So before you go, one, I want to thank you for your expertise. And it's been great having you on this call. For everyone listening, if you are interested in the fund that James is running, the Inflation Beneficiaries Fund. The ticker is INFL. You can go invest in it if you want, or if you want to have a conversation about it, get in touch with me. I will put you directly in touch with Chris Bell. Chris is the Horizon Kinetics National Sales Manager and also member of the Deep Knowledge Investing Board of Advisors. And, we can arrange a call with him, with James, whoever you need to talk to feel comfortable. So it's INFL if you want to go directly. And if not, just shoot me a note. I'll put you in touch.
This was really a great conversation. I look forward to doing more of these. I think that you have really interesting insights and look at the world the right way. And yeah, look, I'll pitch it to the partners to send us down to Saint-Tropez for the Deep Knowledge HK Saint-Tropez Mansion Fund.
Yeah, exactly. Again, everyone on this call, you're going to be invited to invest in that. I'm definitely part of the due diligence team there. So everyone hang out for just a few more minutes. I'm going to run you through a few of our ideas on the inflation and higher rates, are the way we're hedging for it. And James, I know you've got to go. Thank you so much. Looking forward to the next conversation.
Yeah, this was great. Thanks so much for having me.
All right. Take care, James. So for everyone still on the call, I know we're running close to the end of our time here. And so I'm just going to really quickly run you through a few of the things to be thinking about. James is looking for equities that'll outperform in the case of inflation. Some of the old standards for what to do with inflation still apply. You can own gold, silver, Bitcoin, oil. And for everybody who's a little worried about food prices, buy food now. If you can afford it, stock up your refrigerator with meat, fish, whatever you want. If you're on a tighter budget, rice, beans, flour, sugar, coffee, it's not bad to have a little extra stuff lying around. For gold and silver, the easiest way to buy it is through the ETFs, GLD and SLV, respectively. There are some fees for that, but there are also risks to having precious metals in your home. Oil, we like some of the producers with permitted wells. You really don't want to be on the other side of having to get environmental approvals. Now, what we're seeing, and actually I'm going to take a look right now. Yeah, so as expected, higher interest rates have been taking the market down. We have a bunch of stocks that we know and like and think are cheap, and we want to own them. So the issue for us is, how do we hedge for that? And we've been successfully and profitably hedging for that by shorting the S&P 500, shorting the NASDAQ, which is much more sensitive to interest rates than the S&P 500. And we've been buying puts on the indexes. And what we're doing there is we're owning the stocks that we want to own, which have been doing well, and shorting the indexes, which are subject to pressure from higher interest rates caused by inflation. That's how we're handling it. For any of you who want more information on this, you're welcome to sign up at deepknowledgeinvesting.com. There is a free membership option available, or for those of you who want the premium only information where we talk about individual stock ideas, and we let people know what we are buying, and most importantly, when we're exiting a position. You can sign up for the premium subscription, and we're there for you. We've got a recommended list up, and that recommended list, as soon as it changes, you guys are informed right away. So we keep our investors updated on what's happening in real time. When we talk about what's happening in real time, that means what I'm doing in my portfolio. We're advised well by the Deep Knowledge Investing Board of Advisors, and we're following this stuff on a daily basis. So if we're trading something, you guys know about it. That's what we have now. Wishing everybody good luck. Thank you so much for being on today's call. We really appreciate your time and your interest. And if any of you have follow-up questions on the topic, reach out to us at ir@deepknowledgeinvesting.com, and we'll get back to you as soon as possible. Take care, everyone, and thanks for being on.